Déjà vu. I feel like I'm living in the year 2000. All that's really missing is Prince singing "Party Like It's 1999." Let's take a look at the NASDAQ going into 2000 and after. As you can see, we had this massive spike in the NASDAQ at that time, and then as the internet bubble popped, we ended up having a very big downward move. Overall, the NASDAQ went down 78% from March 2000 to October 2002. You can also see that we had this very fast decline from March 2000 to the end of May of 2000. That decline was 38% in a little over 2 months. So when it did roll over, it did have a very big move. One thing to notice is that right after that May sell-off, there was a significant recovery that approached 40% in the NASDAQ from late May into July. I actually tried to trade that rally. I did not trade it successfully back in 2000. The current situation is very similar. We have a large speculative bubble. We have lots of stocks with low revenues, losing lots of money, that have multi-billion-dollar market capitalizations. We had an IPO frenzy that was bringing stocks that really had no business being in the public marketplace to the public marketplace. Back then, they were just done in IPO fashion. This time, they came in the SPACs, the special purpose acquisition entities, and those companies basically could get around the IPO rules by coming public as a SPAC, getting some capital, and then buying the company that was not quite ready really to be an IPO. So we had this massive speculative bubble there. And of course, we had the making famous high-risk, single-sector fund managers who had all their money in one area that really took off. This time it was technology, which is similar to last time. This time was around the work-from-home stocks. The most famous of people to have done this is actually Cathie Wood at ARK. She had phenomenal 2019, 2020, 2021, as you can see right here in this chart, not near as good, and 2022 is also proving to be very difficult. We are buying some of every one of these this morning as I give this speech. We buy them every day, particularly if they are down, which, no surprise, given what they do, is very rare. And we will keep doing so until this period is over. It is very far from ending. Heck, people are just learning these stories on Wall Street, and the more they come to learn, the more they love and own. Most of these companies don't even have earnings per share, so we won't have to be constrained by that methodology for quarters to come. We try to own every one of them, every single one. And if I had my druthers, I wouldn't own any other stocks in the year 2000. While when I started that quote, you probably thought I was quoting Cathie Wood. She has said very similar things last year. This is actually a quote from Jim Cramer in February 2000 as he was touting his red hots, most of which ended up collapsing in the bubble. Both Cathie Wood and Jim Cramer are very smart investors. They overstayed their welcome as their success built a thing that this was going to last forever, and nothing ever lasts forever. Valuation always comes back to matter, and when you don't have stocks that have any credible valuation, you end up having some very significant downside. That is what creates a bubble. The mindset that it's going to last forever is what creates a bubble. I feel very confident that we're probably just past the bubble. Here is a NASDAQ chart overlaid on the 2020. This is the current NASDAQ overlaid. As you can see, we're down about 14%. from the November 19th high. As many of you can recall, on November 3rd, I did put out a video saying that it did look like we're in a bubble, with the area of the bubble that is most pronounced being in the SPACs, and then of course these overvalued, no earnings companies that also have significant downside risk. I do want you to take a look at the downside that continued in the NASDAQ back in 2000. So 14% decline. While painful if you happen to be participating in these stocks, doesn't mean by any stretch it's over. When there's no valuation criteria, it's really hard to find a bottom in a stock when you're coming out of a bubble. So a lot of these stocks still have significant downside. I would be very careful. I would wait to try to buy them. As I mentioned to you earlier, I tried to trade some of these type companies in 2000 into that big rally. I overstayed that post-May, June, July rally, and I got my head handed to me. It's a very dangerous and very difficult game to do. This time, I'm not going to try to trade any of these rallies, which will be there. Plenty of companies are out there today, just as in 2000, that are selling at reasonable valuations of cash flows, earnings, free cash earnings, dividends, and those are things that you should concentrate on. This bubble is not as big, in my opinion, as the bubble that we experienced back in 2000. Back then we had lots of companies, and some of the bigger ones got to really bubble valuations. Cisco was one of the largest at the time, and the valuation on Cisco, it got to up to 100 times earnings, and it ended up being a peak earnings situation as we got past some of the internet build out and people overbuilt, and then you had a downswing in capital spending. This time, the valuations of the super large caps, the Microsoft's, Amazon, Facebook, Apple, while we could argue are a little on the high side, I don't think that they're anywhere near bubble territory. They possibly have 15 to 25% type corrections in them if interest rates continue up. So that is the key thing here. Let's make sure that we continue to follow these interest rates. As you can see here, interest rates have headed down for a very long time frame. We started back up near 15% on the 10 and 30-year Treasury. Nominal GDP was approaching that level as well, and now we're down to a point where the 10 and 30-year Treasury are closer to 2%. Historically, the 10 and 30-year Treasury have sold at similar rate as nominal GDP. That would be something north of 5%. If we do have rates move to a market-based pricing with the ending of taper, we will see rates move up. How fast and how quickly they get taken over by market-based pricing is yet to be determined. But market-based pricing would have 10 and 30-year Treasuries at over 5%. This is the key thing to watch if you're worried about how big a correction is going to be in the stock market. The correction is going to be big even for these large cap stocks that are not grossly overvalued at 2% interest rates, but are going to be overpriced at 5% interest rates. Keep an eye on interest rates if you own the large cap tech, large cap growth stocks. This is going to be playing out. It's very difficult to say because it is more of a human decision based on a very concentrated view. The Fed is going to determine how fast it tapers, whether it follows through with tapering. Does it actually reduce its balance sheet by trillions of dollars, or when it sees that the market is rolling over and the economy is slowing, does it reaccelerate and start another leg of quantitative easing? That's the key element to how deep the correction will be. But without a doubt, use rallies to trade out of your speculative, no earnings, losing money companies, but you can maintain your positions on your larger cap growth stocks that have real earnings, real free cash, real revenues, and are still growing very nicely, but you still might have a correction here. I hope this information is helpful. This is Ben Halliburton. This is Building Benjamins. Please check out our website at buildingbenjamins.com for more information. Thank you.